Welcome to the insurance series. I'm William Freitas from Confio Insurance, and today we've got Kevin LaCroix from RT Specialty. Kevin, welcome to the show.
Thanks for having me, William.
I'm excited to have you on board. You know, it's interesting. I started as an underwriter, financial lines underwriter, back in 2009. And back then we were doing public listed D&O insurance at Zurich, I was. And I frequented the D&O Diary quite often at that point, right? So for those of you who don't know, Kevin LaCroix is the author of the D&O Diary. I'm sure many of you will know. And so I'm excited to have you on board, excited to have this conversation with you. But, you know, tell us a little bit about who you are and you know, where it all started, and then we'll dive into, you know, what the D&O Diary was about.
Well, I suppose the deep background is that I've been involved in D&O insurance one way or the other for more than 40 years. I've worn pretty much all the hats. I was a coverage attorney. I ran a D&O underwriting facility. I'm now a broker. I've actually been on the boards of several organizations, so I really have sat at every seat at the table. The background on the D&O Diary is that in late 2005, I was running the D&O underwriting facility, and I was having disagreements with the senior management of my company, and in hindsight, you could probably say that I was insubordinate because I absolutely did not agree with the policy positions, the direction they were taking things. And I actually wound up quitting. In fairness, I quit before I got fired, I think. But I was out of a job. I was out of a job for about 6 months. And then I wound up deciding to go into business with some friends who I knew from, you know, my background in the industry. And they were spinning out and starting a new wholesale insurance brokerage. And I started working with them in March 2006. And I can now say that it was a very successful enterprise, and it was a terrific move for me professionally. But right at first, I didn't have any business and things were very slow. And so really, as just a way to keep myself busy and maybe keep my hand in, I started to try and do some writing. And I just experimentally, I picked up an app that was available then on Google called Blogger, which was this tool that you could use to set up a blog. And it was very simple to use. And within a few seconds, I had a blog, but with no intention that 19 years later, I would still be doing it. It was really just an experiment with the technology. My timing was fortunate. That was right at the time of the so-called options backdating scandal. And so I had something to write about, and it was something that just turned out to be of a great deal of interest to the D&O insurance industry. And so I was off and running. But even then, I had no plan to continue to do it, that this was going to be a project that I would be working on for years. It really got going during the global financial crisis, right about the time you joined the industry, actually. Yeah. You know, obviously there was a lot going on then. And the interesting thing that happened to the blog at that point is it went from a very small readership among a few people I happen to know to really being international. And to this day, about 40% of my readership is outside the United States, which amuses and amazes me. But I found at then and sort of at every point along the way since that I enjoy doing it. And that's the main reason I keep doing it. I think I'd probably still be doing it even if no one read it. Mm-hmm. I mean, it's a bonus that people do, but it's, you know, it's keeping me going. My 69th birthday is next Wednesday. Wow. I'm well past the usual retirement age in the United States. And one of the reasons I'm continuing to work is I enjoy doing the blog, and I don't think I could do the blog if I weren't in the game. Yeah. So that's just kept me going, and you know, for now, I'm happy to keep going. So it's been this great thing for me personally and professionally, and it has me here in Sydney, which is always great. Yeah. So it's just been a terrific thing for me. I had no idea when I started that any of this would happen. So it's just been a wonderful experience. And
you're obviously here for a conference in Sydney.
Yes.
And you've been a great advocate for directors and officers insurance. You know, for yes. anyone listening who hasn't listened to our D&O podcast in the past. D&O is for directors and officers insurance. And obviously you have a great passion for D&O insurance. Do you think it's that you enjoy writing about D&O, or is it that you enjoy sort of that education piece for the readership? And is the readership predominantly people within the industry or clients?
So answering your first question first, my passion for D&O, as opposed to the passion for my blog, is just because it's an interesting topic. As I said earlier, I've been doing this more than 40 years, and it's always something new. And I love that part. That you'll get a strange claim or a weird coverage defense, and so it's always something new. So that's where my passion for D&O insurance comes from. As for who my audience is, it is primarily D&O insurance professionals, underwriters, brokers, claims attorneys. But there are also academics, there are journalists, there are business students. A lot of my readership, I just know from communication with them, they're in business school, they're in law school. And that's always gratifying to me, because I do view one of the purposes of the blog to be educational. When I write, the person I have in mind is about a 3-year underwriter. I'm not aiming to be rudimentary. I'm not aiming to be basic. I'm aiming to try and help the person that now has a little bit of background, a little bit of experience, gain the insights they need to deal day to day with the problems that are likely to come up. And I think the 3rd year is probably important, because by then they've probably had something blow up on them. And so they've gained a little humility, and they know how much they have to learn. And my consolation to them is, again, I've been doing it more than 40 years, and I still have a lot to learn. And there's a lot to talk about. So I hope it's a good resource for everybody, but especially for those younger folks in the industry. And that's really who I'm trying to talk to when I write the posts.
And look, for anyone who isn't aware of the D&O Diary already, it's been referred to by the New York Times as influential. And by many others, widely followed.
Yeah.
And it's interesting to hear your perspective on who it is that you write for. Because at that point I was a 3-year underwriter, reviewing those blogs and getting a feel for what D&O was, and educating myself in that
One
perspective.
thing I hear frequently from the young folks, and this is kind of too bad, but one of the reasons they tell me that they value it is they don't get any training in their job, which is really too bad. I know everybody's busy and budgets are tight, but you really, I ran a D&O underwriting facility, and I know you have to invest in your people. And it's too bad that they don't get that kind of training. I'm glad that I can help try and fill that gap. But, if I could send a message to my counterparts out there in the industry, it'd be, invest in your people. It's really important. And, they're not going to be young forever. They're going to move on, and they're going to go to management positions, and, you want them to be equipped to handle that. So just an aside on the industry these days.
Yeah, and the beauty of D&O insurance that I find is that it is so broad.
Yeah.
There's so many different issues in today's business world can relate to risks that are associated with being on a board. And so educating your underwriters so that they can then pass on those messages to brokers, and brokers then educate their clients on boards is a huge value add. Yeah. I'm now a broker, so I love educating boards around what their key risks are, and that's what I love about D&O really. Is
I actually agree with you. That is, I don't get the opportunity often enough, but when I do get to speak to boards, it really is, I learn a lot too. I probably learn as much as they do, because their questions teach me a lot. But it really is one of the great things about what we do, to have that opportunity to exchange ideas and information with, senior business leaders, and it's just a pleasurable thing we get to do as part of our job.
And tell me why blogging, really quickly. That medium specifically. Do you enjoy writing? Have you ever thought? We're doing a podcast right now.
I have done podcasts before, and more than 10 years ago, I got fairly far down the road with a colleague that was going to help me start doing it regularly. He had problems in his personal life, so he had to step away, and I've just never had the time myself to just focus on that. If I were starting out today, I probably would not use the blogging medium. I think I'd try and find other social networking tools. If you read my blog, anyone listening to this reads my blog, you know that I tend to write longer posts. The joke I make is I don't have time to write a shorter one. I wish I could make them shorter, and in a perfect world, they would be shorter. I think it's probably one of the detriments of the way I do things that it is so long. People are busy. They've got to decide how they're going to invest their time every day. It's a last generation medium. I think, the blogging platform. So in some ways, I feel like I'm beyond old school and kind of fading away. But I still think that the need is there. I probably use LinkedIn if I were starting out today. I would do more podcasts. For anybody out there that's thinking of trying to replicate what I did, I think you might want to try expand your concept of what platform you might use or how you might achieve the same thing using some other tool. But the blogging for me works because I was an English major in college. I like to write. For the people that do invest the time to read the longer posts, I think they get value. At least that's my goal. So that part just feels good to me, and it feels right to me, whether it's a current technology or not.
I mean, in terms of the readership, being underwriters, most D&O underwriters are used to being knee-deep into annual reports anyway,
Right.
which are 80 pages long. So
Yeah.
reading a blog is probably a medium that works for them anyway.
I know that not everybody reads it every day. In fact, I really don't write it with the idea that people are going to read it every day. I hope once or twice a week I hit on a topic that's of interest to you or other readers. And if I don't, they'll find something else to do. But that's my goal, that, no one's going to, my mother doesn't read it every day. And I don't think that it would necessarily be worth your time to read it every day. But I hope that every now and then I hit on topics that are of general interest or interest to people that, are busy but yet they find a reason to read it.
And so on that topic, how many readers do you have consistently?
So a typical day, I get about 10,000 hits. I have roughly 9,500 subscribers, which I think is pretty close to the top end. I don't know, it's a relatively limited universe, and it's pretty rare that I run across somebody that hasn't heard of it, in our industry. So I think probably the readership is about topped out.
Yeah.
I do enjoy traveling overseas and finding out that people, for example, in Australia read it, but other countries. I was in Czechoslovakia, or rather the Czech Republic, in June, and it was a meeting of employees of a reinsurance company from all over Europe, and it was pretty gratifying to find out that people from Croatia and Estonia and Bulgaria were reading it, which the internet is an amazing thing. So, that's crazy to me, but it is pretty cool. I sit there in Cleveland, Ohio, type out my blog post, and off it goes. And someone in Australia or someone in Bulgaria can be reading it, which is just, the internet's amazing.
And there can be some market specificities, I guess, or for each country.
Yeah.
But there is commonly D&O is a broad product, and
it is.
Effectively it can be very similar across regions.
Well, there are always market specifics, and I don't always know those in advance. It's very interesting to me to go to other countries and hear about those market specifics. Sometimes I learn things that are actually useful to take back. Sometimes it just helps to have the context. One thing that I think I can communicate, even though my experience is limited to the U.S., my professional career has been in the U.S., that's my background. But we have so many claims. We're a very litigious society, and so we have deeper claims data than just about any other country. And anybody that confronts the data can decide how useful it is for them in their market. But sometimes it just helps to have the data. And there are enough data points that you can describe differences in the data or draw conclusions about what kinds of fact patterns, what kind of scenarios produce claims. Not necessarily meaning that that's going to happen in your country, but it helps you understand, what the product can be there for and how it might have to respond.
And we might come back to some claim scenarios a bit later on if you've got some options.
Sure.
But my question is, what sort of topics light your readers up? And it might be claims examples. I find when we put out content around claims, that's the juice, right? That's what people. That's where people learn about the product.
Yeah.
That's where people get a feel for the product.
I feel
what
like
are those
my
topics?
job, almost in a journalistic sense, to the people I'm writing to, is to do trend spotting. Currently, for example, about AI or ESG or cybersecurity. One of the things I talked about at the APIG conference yesterday is about the potential D&O exposure from the U.S. tariffs. My hope is on that kind of stuff that I can help people see around the corner a little bit, so what might be over the horizon, or even just to have the insight that can come from learning that there was a claim filed with that fact pattern, and that can help the underwriters thinking about their risk across their portfolio or even in connection with a single account, and can help brokers think about what kind of problems their clients may have and what the liability and insurance implications are. So I view that as my role, trend spotting.
Well, let's chat about some of those trends then,
Yeah, sure.
I guess. What are you seeing, more broadly? And I mean, US tariffs is a great option, but definitely I know cyber and AI, that's something that people are very interested in.
Well, AI for sure. And in my view, it is a rapidly emerging and very important potential source of claims. Just to unpack that a little bit, there are really three categories of security suits that I would say have been filed so far in AI-related claims. The first is just against the AI companies themselves. Peculiar features in the current climate for AI companies is they tend to be very highly valued, and they're priced for the promise of future profits. And so they have very lofty valuations, and any stumble, their share price plummets. And so they get hit with a security suit over the declining stock market value. That's not unusual. There have been other industries in the past where there have been, biotechnology, internet companies back in the internet bubble days. But there's a lot of market darlings, especially on the U.S. securities markets right now. So that's one category. The next category I think will be familiar to most of the people listening to this is the phenomenon called AI washing, which is the company portrays itself as better able to exploit AI technology and thus has better prospects and opportunities or better capabilities because of AI. And it's already pretty common for there to be allegations that the company overstated either its capabilities or its prospects. A lot of times there's a core fraud element that really they're not actually using AI or something like that, or they've misrepresented what benefits it's producing. The third category is one that is the most interesting to me, and that's rather than talking about your prospects or opportunities from AI, is failing to talk about the risks that come with AI. And I have a good actual live claims example. It involves the company Reddit, which is an internet-based, basically community bulletin board. One person will post a question and then people in the community will post responses. They make their money from advertising revenue, and the way they get their readers is people will type their question into Google, and Google will give them the blue links, often which link to Reddit. So that drives traffic. That traffic produces ad revenue for Reddit. What's happened in the last less than a year, Google has started giving its results in the form of AI answers. They call it Google Overview, and you've probably seen it, where you get like a paragraph of text that answers your question. I frankly love it. It really is efficient, and it's a good illustration of how AI can make you more efficient. But it's very bad for Reddit, because what that means is instead of the people, when they do their Google search, getting the blue links that will take them to Reddit, they're getting their answer. They don't need to go to Reddit. So Reddit has seen its readership plunge to the point of like 15% a quarter over several quarters. And where they got in trouble is they were reassuring securities analysts that, we've gone through changes at Google before, we're gonna work this out. But at this point, it's pretty clear it's affecting their business model. The reason I like that example, it's almost like a teaching example, is number one, what it's about is the failure to disclose risks from the impact AI was going to have on their business model. Now, they may not have anticipated the impact, but the allegation is that they failed to adequately disclose the risks from Google's adoption of AI. The other reason I really like the example, it wasn't Reddit's adoption of AI. It was effectively a supplier, because Google supplied the readership. You think about that, every industry out there, there's competitors trying to figure out how they're going to use AI to improve their prospects, to improve their business model. And that's going to affect everyone in their ecosystem. So the danger comes not just from companies' own adoption of AI, it's from customers, suppliers, regulators, and it's coming from a lot of directions. And I think that's a threat really for really any enterprise today, just in and of itself. But I think it represents a kind of developing D&O risk that I think it's very hard to measure. Just take an example, like, I don't know, cardboard manufacturing. I actually work with a cardboard manufacturer in Indiana. Old line business, very staid, very stable business. But let's say that their largest competitor comes up with a way to use AI to offload a lot of their labor costs. And so their business model allows them to cut what they charge their customers. And so all the business floods away from their competitors and goes to them. Now, that's a hypothetical, but I think you can see that with respect to any industry, that fact pattern is possible in ways that probably exceed my imagination to even anticipate. But I think if we were to come back 5 years from now and do this podcast recording, we would be talking about the many examples that some version of that scenario has played out. So even though the most common type of AI-related claim to this point has been AI washing, I think that's about to shift. I think it's going to go more towards undisclosed AI risk.
I tend to agree, and particularly with AI washing, I think many boards misunderstand what AI is in general, and more broadly across the industry. The word AI has become a real buzzword. Anything that has AI is exciting, and boards sort of rely on that. And they think potentially using a large language model like ChatGPT is utilizing AI. And I think the market's getting a lot more sophisticated now with saying, well, actually, the use of AI isn't just a large language model. It's various other methods of using AI. And so to come out to the market and to insinuate that you're using AI and you're going to be front of mind, because that is really what investors
expect. If we're
expect.
using Google these days, we're using AI. And so there's no big news that people are using AI. There really is, are you using AI in a way that's going to improve your business results, change your business model, streamline your processes, allow you to cut your labor costs, those kinds of things. And for better or worse, companies are going to be talking about those things publicly. And I think, that's, if they aren't straightforward or they don't have a good handle on it or whatever, they're potentially setting up the stage for later problems and potentially later claims.
And I like your humility in the sense that there are elements of AI that we can't fathom what type of claims could occur from this. And probably not so much in the D&O space, but in the professional indemnity space, what we've seen in Australia, a little bit too rashly, but some insurers have applied sort of generative AI exclusions onto policies. And I think that's really quite...
Are you really seeing that?
Yeah.
I've heard of that in the US, but I've not actually seen it myself, but you've actually seen it?
Correct.
That's interesting. To what kind of coverages? To D&O?
No, primarily professional risk, so PI.
Okay, I can see that. See that.
But, I can see that approach flowing through from an underwriter going, okay, well, we're really frettish around AI in general, and their view on D&O might change. I hope that doesn't happen.
Well, my response to them, and this is less so in the PI space, more in the D&O space, I've had occasion to go through all of the D&O securities class action lawsuit AI-related claims. It's not that many, and you can go through all of them. And although they involve AI, otherwise they're completely plain vanilla. There's nothing unusual about them other than they happen to be about fact patterns that involve AI. It's exactly what D&O insurance is for. It's the thing that people pay their money for to get coverage for those kind of claims. So I would push back. I'm sure we're all, did you say frettish? That's what a great word. But I think we're all frettish, and there's a lot of uncertainty. But the claims they're not unusual claims. They're very plain vanilla claims in a lot of ways. So I just don't think that's the right approach. Or I would say, if you're not going to insure that kind of risk, just get out of D&O, because it's what you're supposed to be doing. So
you're enduring the fundamentals
Yeah.
effectively. So that's what you would expect to see, I guess.
Exactly.
And you know, when we talk about this specifically for the context of everyone listening, we are largely talking about public listed D&O, where valuations can significantly change.
Point. That's what I do.
Yeah.
And if I wasn't clear about that, I probably should. You know, I don't work a lot with private companies.
Yeah.
I don't work a lot with like nonprofits or NGOs or anything like that. So,
but it's an evolving space, AI in general. I think,
yes.
You know, the understanding of what AI can do today, like you said, in 5 years' time will be completely different because the technology in itself is evolving.
Yeah, I mean, anybody that's been working with it over like the 2 years' time has seen how different it is now and how much more simple it is to use and how better the results are. It's true.
And I think too, you can dovetail that really nicely with cyber.
Yeah.
The type of attacks that we're seeing on a cyber front, you know, rightfully so, should caution a lot of boards around what they are doing from a cyber risk perspective and how they're approaching that risk. Because, you know, particularly with the involvement of AI and how quickly cyber attacks can evolve, it's definitely a key interest.
And the use of AI to create deep fakes, you know, and this is something I wrote about just in the last couple of weeks on my blog. Some of the examples are really frightening because they can, with just a very small sample of someone's voice, they can make a completely convincing audio and even video recording that, you know, are so well crafted that they can fool even a very vigilant guardian. And so the CEO of the company, who regularly does interviews on TV, you know, the bad guys have all kinds of footage to work with, and they can put together, you know, and some of the deep fakes are so convincing. But that's really what frightens me.
We recently sat down with a client of ours who ran a little workshop for their clients, and they specialize in cybersecurity, and they ran a deep fake of the CEO interviewing Ryan Gosling. And it was actually really quite refreshing and alarming at the same time to see how easy it would be to do.
I attended a demonstration. It was very much along the lines of what you described, but halfway into the demonstration, he said, you know, I think this would be better in Russian. And so he hit a bunch of buttons, and then it was the same voice speaking in Russian. It was just... It was crazy.
I'm sure we could interpret this into Spanish or Russian, this podcast itself, and have that your readership in you know, Spain or Russia be able to listen in. That'd be fantastic. Talk to us about the tariff exposure that you're seeing.
Yeah, this was one of the topics in my presentation yesterday, and I think it was more interesting than the audience thought it was going to be before I started talking about it. I first started talking about some questions that seemingly are only of interest to Americans, which are the constitutional law questions about whether the president actually has the power to impose tariffs. In my humble opinion, he does not, and that has actually been the views of the court so far. That creates a lot of uncertainty for our clients. Anybody whose business is subject to U.S. tariffs, it creates a lot of business planning, strategizing difficulty. Setting that aside, I think there are two particular ways the current global trade environment could lead to D&O claims. And the first is, like any tax, a tariff creates incentives for people to try to invade. And there are various laws in the US that give the government the authority to pursue claims against companies that the government believes have sought to evade taxes. And there are already examples of cases where the government alleges, for example, in April this year, South Carolina furniture manufacturer that imports its furniture from China allegedly was maintaining two sets of books, one of which was the one they used to report to the government that made it look like the costs of their imports were lower, and then another one that accurately reflected that, in fact, the costs of the imports were higher, and it resulted in an underpayment of the tariffs. And interestingly, the way this case came to the attention of the government is a competitor reported it, which shows you one of the dangers. So that's sort of the tariff enforcement, which is its own set. But there's another category which I'm more worried about, which is tariff-related disclosures, because companies whose business models subject their business operations processes to tariffs will have to make disclosures about how that's going to affect their business to their investors. And they will also have occasion to talk about whether they can modify their business model to import from lower tariff jurisdictions and so on. And I've been saying that since the tariffs went into effect. As of last Friday, I now have an example of a case where the allegation is that the company misrepresented its exposure to its business model's exposure to tariffs. The company involved is Dow Chemical, which is one of the major American industrial companies. You know, it's right up there with Ford or Boeing as sort of an iconic American business, been around for 120 or more years. And so just as an aside, if a company like that is having a problem with tariffs, it tells you something. But the allegation in the lawsuit that was filed last Friday is that the company kind of soft pedaled the impact that the tariffs would have on their financial results. And in particular, they were pretty adamant that they were going to be able to maintain their very generous dividend. And in their most recent financial report in July, reporting on their second quarter results, they had to admit that the disappointing results they were showing were the impact of the tariffs, and they were cutting their dividend. So I'm sorry it happened to that company, but it is a very teachable example. And what's true of the American companies is true of companies in other countries whose goods are imported to the United States and therefore subject to the tariffs. And it's going to have effects all the way around. You know, if you've been sourcing your goods in Brazil, which is one of the higher tariff jurisdictions now under the current regime, you have an incentive to see if you can source your goods from Japan, where we've now reached an agreement with Japan. Now, you may or may not be able to do that, but you have an incentive to try and do that. And I think, so regardless of country, because the tariffs are so widespread, affecting so many companies, even though it's a U.S.-oriented problem, it's not restricted just to the U.S. And so, and it's not going to go away, at least not in the next few months. It's not going to go away.
And I'll add to that, the competitiveness aspect is what drives boards and companies to review how it is they source product or how it is that their whole logistics operates.
Right.
It isn't necessarily just I mean, cost obviously is a big part of that, but then quality changes too. And so it definitely drives them to think differently. And I think for anyone who is, you know, potentially been in that 2 to 3 year underwriting career journey, I think when I was underwriting, I always heard, if you invested in a company at $100 share price, that's based on the information that you were given at that point.
Right.
And if you are of the opinion that the tariffs are not going to impact the business all that significantly, but really it would be, and the true value is $85, for example, because of that impact, 12 months down the track, when the company, as you suggested, comes out and says, actually, we're not releasing a significant dividend as we had planned to do.
Exactly.
Our share price comes down. The difference in that share price is exactly what is the financial loss to the shareholders, right? And that's often where you see the claims.
In the U.S., at least, that fact scenario would result in a securities class action lawsuit. Now, other jurisdictions, their lawyers have to make different calculations. It may or may not result. But that's the source of a lot of the public company D&O claims in the U.S. is exactly, you know, that it was overvalued because of the misimpression that investors had about the prospects of the company.
And that's the importance of valuation and disclosure, The importance of disclosure on valuation and how that impacts that. I think as an advisor, you know, we often talk to our boards around, you know, obviously there's a set guide around what they need to disclose, but around specifically the timing of that too, you know, and trying to be as upfront as possible around all risks, so that the market is very well aware of all risks considered, whether it be AI or tariffs or whatever it might be. No, that's a good point. Let's talk about, I guess, limit setting. This is something that's pretty challenging, I'd say, to some degree for an advisor to set. You know, we can always benchmark what a business of that size would carry. And that is a good way to guide the client around what limit they should purchase. But and naturally, when I was underwriting, we would look at things like board composition and various different factors around revenue and all that sort of stuff, industry. But what are some of the things that you would factor in when it comes to limit deployment or limit attachment?
As advisors, because I serve a similar role to you in the U.S., we try and use our own data, peer purchasing patterns. What does a company like mine typically buy? You're right, though. That's not the end of the analysis. I mean, I will tell you, in my experience, banks in the United States don't buy enough D&O insurance. Technology companies tend to overbuy. So you can get that kind of thing. So the other thing we try and do, and we can do this in the United States because there's so much data, is we can run scenarios. What's your current market capitalization? What would happen if you were to lose 50% of your market cap value and there were to be a securities class action lawsuit? What would the settlement range for a company with a starting value that you had? What would the settlement range look like? So making sure that you have enough insurance for sort of the foreseeable bad claim. We don't do worst case scenarios because I think that would result in kind of overshooting the mark. So we use what we call worser case, so 75th percentile results, and we try and give our clients enough data points, and they can backfill to see what those claims actually were. So not just dots on a chart, but okay, what lawsuit was that? Is that a lawsuit that reflects on my company? And so, and different buyers are different about that. Although I will say that the D&O product, the person that's making the buying decision often is the CFO, and they love data points. So that's actually a very gratifying process for them to see that. But if the buyer is actually controlled by the general counsel, they want more anecdote. They want more stories. They want to hear about, tell me about the last settlement you were involved in and things like that. One thing I always say is there's no right answer. There's the answer that's right for your company. And that's a mix of risk tolerance, affordability, marketplace environment. What we saw during the hard market in the 2019 to 2021 timeframe is people started cutting their limits just because they ran out of money to spend on insurance. What's happened since then, as the pricing has dropped, they've used the savings to buy more insurance. So, there are a lot of things like that go into it. And we try to give them the information so that they can make the decision, but try not to make the decision ourselves. But sometimes I can't help myself. I just say, you're not buying enough insurance. I know that sounds like I'm trying to sell you insurance, but I've been doing this for 40 years, and you're going to have enough to defend the claim, but you're not going to have enough to settle it. And you don't want to be in that position. And you definitely don't have enough for a really bad scenario where you not only have a securities class action lawsuit, but perhaps you have an SEC enforcement action. Maybe you have a criminal action. Do you have enough insurance to be able to pay the defense bills of everyone that's going to need a lawyer in that type of, and they're not thinking that way. All too often, as you know, buyers are very focused on price. And it's my job to make sure that you make your decision on that basis if that's what's important to you. But please make sure you're taking other things into account when you decide whether or not that's the right call.
And it's interesting you mentioned that, if we rewind 5 years ago, a lot of our clients were sort of looking at the side C pricing, that is the security class action pricing, and opting to not insure because of how expensive it was. Excesses were going through the roof, pricing was going through the roof. So particularly in Australia, it was an interesting landscape. A lot of clients were pulling back on side C coverage. Now, as the market is softening, that they are looking at adopting that again.
It's an interesting way that the Australian market developed to respond to the rise in securities class actions in Australia. That never happened in the States. We never got to the point where, I'm sure if we searched the universe of companies, there were companies that were only buying A and B. And in fact, I know there are very, very large companies that only buy A. That's fairly common. But the vast run of public companies, they never had to deal with a marketplace they couldn't also get the C with their A and B
Yeah.
at pricing that was acceptable.
And while we've got you, it'd be silly of us not to get a bit of a masterclass around side A, B, and C. What's your view on standalone side A policies and how they play a part, and how you balance that across a shared program for A, B, and C?
I mean, to me, a well-constructed D&O program has A, B, C, and excess side A to provide catastrophic coverage for the individuals, to kind of ensure that sort of no matter what happens, there's going to be a pot of money available for the individuals in a crisis scenario. And I think companies that have had claims before are easily persuaded of the wisdom of that. Not all buyers want to spend the extra money. The kind of buyer that would buy just a standalone side A, they typically are very well capitalized. They probably have a better balance sheet than the insurance company. And it's very hard for them to imagine a scenario where they're going to be insolvent and not be able to honor their indemnification obligation to their individual directors and officers. But the individual directors and officers still insist. That's fine, but just for my own peace of mind, let's have a program that, and you know, a company like Microsoft, I actually don't know what their insurance program is, but they've got more than $100 billion on their balance sheet. They don't really need insurance. They can self-insure, and they do for a lot of lines like property and so on. But I can easily imagine a board member saying, that's fine, but because it's not going to cost that much, because the underwriter is going to look at it and say, what are the chances that I'm ever going to have to pay out on this? So that's not an uncommon scenario, but the typical buyer, you know, there are roughly 8,000 publicly traded companies in the U.S. 7,500 of them buy ABC.
And I think if you're a director and you're sitting there thinking, okay, well, am I going to join this company? There's quite a lot of trust that is involved in, happy for us to rely on your balance sheet.
So you'll be very interested, I think you'll relate to this. One of my clients is a very, very large financial institution. It's a Fortune 50 company. And I am hired by the board to advise them separately on the insurance. The insurance program is placed by management, senior management, the CFO, the general counsel. But my role is to review the program, not from the perspective of the company, but from their perspective. And it's a really interesting process. Very sophisticated people. They know a lot about the product and what's it for and so on. But I just think it's interesting to consider it under the guise that the board's interests may not be the same as the company.
Agreed.
And in fact, your conversation about separating C from A and B is kind of representative of that, of how the interests do diverge. And so it's often a puzzle to me how we got started having the coverages under the same policy, because analytically you'd almost say they shouldn't be in the same policy. They should be separate policies.
You would tend to think so.
Yeah.
Now, naturally, I presume they've been incorporated because they can be somewhat related to some degree.
Yeah.
However, I really like that. I think there's so much value in having independent advice for the board, for each individual board member also.
But
Because
just to make sure I'm not ambushing somebody, I always share my results with the broker who places. I'm never just, with the board's permission, I share it with the people who are engaging directly in the transaction.
Yeah.
They have a very well-designed program, and I've told them so. I've never really been critical. A lot of discussion around limits and side A cover and so on, but never anything critical. If they spend a lot of money on insurance, their insurance program has got to be one of the largest in the U.S. So they're very well protected.
And I think what's important there too is, and I'll get you potentially to chat about claims that you've seen in order of protection, versus executive directors and non-executive directors, and the level of protection that is left over for non-executive directors.
Yeah.
What have you seen in that space, and then how does that tend to relate, obviously, in the US?
The worst examples are almost from a different era. This is going back a ways, probably further than the memories of some of the people listening to this, but the era of corporate scandals, Enron, WorldCom, Tyco, massive D&O claims. And one of the features of the settlements, particularly of both Enron and WorldCom, was that the individual directors had to pay and they could not seek indemnity from the company or the insurance, which is, your worst nightmare scenario. It's always good to have an example like that in your back pocket because it is a teachable, but I've been doing it 40 years, I've said, and I can cite maybe a handful of cases where that's happened. There have been cases, more common, where as a result of a settlement with the SEC insists that individuals contribute. And they may or may not permit indemnification or insurance, but they're kind of sending a signal. What I worry about most is not so much the settlements, it's the defense costs, because what you don't want to have happen is that there are still claims pending and you're out of insurance. And that's why I like the excess side A vehicle, is there's always that there to protect. Usually I would set it up for the independent directors, the outside directors, so that they're protected. It's a question you should have periodically with your clients, I think. I think it's a good exercise to think about that and to run by them the fact pattern that involves not just the run-of-the-mill securities class action lawsuit, but the multiple claim scenario where you've got a derivative claim and a securities lawsuit and an SEC proceeding, or maybe even a criminal proceeding. And if there's a criminal proceeding, everybody wants their own lawyer. Absolutely. And the meters are running. And it's useful to walk through that scenario. A lot of people think that's never going to happen to me. And to which I say, this is where I can invoke my experience and say, in the 40 years I've been doing this, I've probably seen it's more than 2,000. And the day before each of those 2,000 companies got sued, they said the same thing. So it's not that kind of exposure. And often it's not the kind of exposure you see coming. Yeah. It can come right over the horizon before you even know how bad things have gotten.
And it's interesting how quickly limits can be exhausted.
Oh yeah,
that's for sure.
Good defense lawyers, we all know, aren't cheap. And in a serious claim, the bills can it's kind of shocking how fast the bills can mount up.
Now, talk to me a little bit about the global pricing landscape of D&O. I mean, to tell you a little bit about Australia, it's softened significantly in the D&O space, in the last couple of years, which is interesting. Many people would think that D&O underwriters have a short memory when it comes to the claims that we were seeing.
Well, if they think that, they're right.
And so it is rather surprising at times, but it's a really softening space in Australia. Are you seeing the same globally?
Same in the U.S. I mean, the insurance capital is not, it's borderless. It's the same pool of capital. Yeah. And so the marketplace, it may not be identical, but it's the same forces at play. As in Australia and the U.S., prices have been falling since about early 2022. The magnitude of the drops has diminished. More recently, I would say for publicly traded D&O in the U.S., the primary is kind of stabilized. There's still competition for excess, still competition in private space. But the question I always get is, it's a cyclical business. When we get to the next phase in the cycle? And my answer there is, having been doing this for more than 40 years, I would say of that time period, maybe 35 or 36 of those years it was a soft market. The soft markets are long and the hard markets are short and infrequent. The things that caused the market to soften was the fact that in the last hard market, capital was drawn into the space. There were new facilities that are online and competing for business with the old line markets. There still is ample capacity. And until capacity starts getting driven out of the marketplace, the laws of supply and demand control. There's ample supply. That means there's going to be competition. That means prices are going to remain advantageous to buyers. When is the cycle? My crystal ball is no better than anyone else's, but if I had to say, I don't think it's this year. I don't think it's next year. I think it's somewhere down the road.
Agreed.
I often in the soft market phase of the cycle, you'll hear voices saying, this is outrageous. The pricing has gone below a risk-adjusted price, and we're baking in money losing results. And I said, yeah, but those results don't show up for several years. Right now, most of the insurers are harvesting reserve oversupply to produce acceptable calendar year results. And they can probably continue to do that for at least a couple of years. So I don't anticipate the cycle moving into the next phase, 2 years is the minimum. And honestly, if I had to like make a guess, like at a pool or something like that, I would say 3-4 years at a minimum.
Yeah, I tend to agree with that. Let's touch on M&A a little bit. I can see, I'm starting to see the M&A activity increase.
Yeah.
Speaking to a couple of clients just this week, and they're looking at some M&A.
Yeah.
And so when it comes to deal time, there are obviously some things to consider when it comes to the directors and officers insurance, change of control, runoff.
Mm-hmm.
Talk to us a little bit about that and some of the, I guess, things you've seen that need to be, considered carefully.
Well, the main thing, and this is going to sound so rudimentary. It's almost like, why do you have to say it out loud? But the main thing is, when there's change in control, you have to get the past acts protected, and you have to get the forward acts protected, and you have to be very careful on what the date is. There's the dividing line. I just went through a scenario recently with one of our clients. The company is mostly owned by private equity, and they're in hard times, and they're amongst themselves very worried about whether they're going to make it. And the private equity representative sits on the board, is kind of gone on the warpath saying, we need to get the runoff in place now. And I'm saying, you can't do that. I mean, if you trigger it today, there's going to be all the acts that take place between today and the day that the company goes belly up.
I mean, sure.
What you can do is prepay, because what his real concern was, they're in such bad shape that they won't have the money when the day comes to put runoff in place. And apparently he had that happen at a prior company. I said, okay. Here's what we're going to do. We're going to buy it now, and we're going to get the underwriter to agree. We're going to leave the date blank. And the date is going to be either the day you file for bankruptcy, or the day you liquidate, or the day you get bought. But none of us today know what that date is. So it sounds crazy that you even have to talk about that kind of stuff, because as insurance professionals, we can see that. But as sort of lay people in the sense of the insurance world, his concern was, I don't want to have the risk that there's no D&O insurance around if this company actually really does go belly up. But the key is making sure that the past acts have all taken place and that they're covered for any future claim. And then if there is a go-forward operation, that whatever it is, that there's appropriate adequate insurance for the going forward enterprise as well.
I agree. There are so many things to consider when it comes to that. And you're talking about, the potential of a company not making it through. But even I find when it is that they're being sold, they agree on a sale price, and they often don't want to eat into that sale price when it comes to managing risk, whether it's runoff coverage or whatever it might be. And they haven't really considered insurance until the final hurdle.
The good news is the sophisticated lawyers that typically are involved in larger M&A are all over it. They know, they understand the process, they understand how it works. And often the private equity people are very knowledgeable about it as well. But you're right, especially in smaller deals, you could well have people, they're so worried about maintaining margins and so on that, insurance becomes, an irritant or something at the margins. Forgetting that that's the only thing that's going to protect you if the company no longer exists and you've gone off to Mallorca, but then there's a claim that comes in alleging wrongful acts during the time you were involved with a predecessor entity. Anybody that's been through that understands, but if you haven't, you may undervalue the protection you get from that runoff insurance.
And I really appreciate that approach around purchasing runoff coverage prior to there being a date set, because often what I've found is the decision maker or the buyer may not be there in 6 months' time, for example, and then the communication with the insurer can break down. So that's quite an important one.
Well, one of the reasons this whole conversation is important for anybody that's lived with claims, that there are a lot of claims arising out of M&A. In fact, that's one of the reasons why that's what underwriters always ask about, because they know that M&A activity does produce claims. And that's why this whole discussion is important, because it's one of the key contexts where D&O claims arise. And it's something that, as advisors, we have to be very careful to make sure we walk through with our clients.
And we could probably do a whole nother podcast on warranties and indemnities and the
In
like.
fact, I would recommend that, but get somebody other than me. I have a team of colleagues who are experts, and I can dabble in it and I can bluff my way through, but they're experts.
Yeah.
So I actually think it would be a good topic for another, but I'm not the right person.
Yeah, no, that's fine. And so I like that you often, brief individual directors or boards separately.
Yeah.
If you were to brief a first-time director, and if you were to say, look, in 5 minutes, this is what you should read, this is what you should ask, this is what you should fix before year end.
First, I want to know who's placing it. And I don't mean from the advisor, I mean internally within the company. And how sophisticated is that person about what they're doing? And then who their advisors are and what they're getting their information. But then how much insurance they buy, how's it structured, is there Side A insurance, how much, and in the structure, how much is set aside to provide protection for the directors as opposed to the company. They should also ask questions about some of the rudimentary risk management things that every company should have about disclosure controls, financial reporting controls. They should have asked those questions anyway before they even got to the point about D&O. But it's good to understand, what investments the company has made and those sort of process things that help minimize the risks. You want to be protected if there is a claim, but there are also really important things you can do to try and reduce the possibility of a claim. And I think that's probably as important or even more important than asking about the insurance.
That's a great point.
Yeah.
We often work with CFOs,
Right.
and we would regularly recommend that we get in front of the board and talk them through the program. Sometimes we get in front of the board, sometimes we don't.
Right.
Sometimes, like you said, there's a sophisticated board member who says, I want to get the CFO and the insurance advisor in the meeting. Let's go through this together and let's understand what it is that we're insured for. So
one more thing in answer to your question about what I would say to a new individual director, before I even got to insurance, I would talk about indemnification, because the insurance contract is an annual contract. It's time limited, it has exclusions, it's subject to the financial stability of the insurance company, whereas the indemnification is usually not dollar limited. It's not an annual thing. It may be what proves to be as or more important, the insurance. So start there. I don't know in Australia if this is a thing, but in the US, many of the individual directors have separate individual indemnification agreements with the company, and it's something that I think is a very, very good idea. It can put in place things like mechanisms for how to deal with disputes and provisions about how frequently indemnification and advancement obligations are going to be paid. So that's something I would add to that conversation.
Okay.
It's not exactly what you meant when you asked me the question, but I think that's as important a part of the conversation. Often the directors aren't thinking about that, especially if they haven't been on the board of another company, and certainly if they've not been through a claim before. So that's an important part of the conversation as well.
Perfect. Is that something that you would do? You would advise on? Or is that something that
If they ask, I have samples. I say that you're free to look at these. These are not my samples, and I'm not providing legal advice. But just so you can see what this is like, what you should do if this is something you're interested in is you should get your own personal lawyer.
Yeah.
And they should advise you, because and I know we can't slip into practicing law. It'd be very dangerous.
You've got that background, so you can,
I do,
you can
but
review it, but you can't provide it.
Yeah, I'm not your legal advisor.
Yeah.
You should get your own legal advisor.
Yeah.
Yeah.
But it's a great approach, and
Yeah.
from a risk perspective, it's something we should definitely be speaking to directors about in terms of their indemnification
There's an
agreements.
organization in the U.S. called the National Venture Capital Association, and they literally have on their website that you can just download a sample indemnification agreement. It's very good. So I feel like, okay, here's the NVCA's example. Take it to your lawyer. You guys figure out whether this form is good for you. But I'm not advocating. I'm just showing you this as an example.
Yeah. Kevin, it's been fantastic to have you on the show. I'm going to finish off with, what does the future of D&O risk look like, and what's some of the things that we'll be talking about in 2026? We've spoken about maybe 5 years' time being AI.
Yeah, I'm going to go a little longer
future.
time frame.
Okay.
This is a thought problem for all of us in the space. I think we all have had conversations over recent years about ESG, which I think is a very interesting and important topic. We didn't talk about it in this podcast, but it's one that I often talk about. I want to reconceptualize the concern for us as professionals and then for boards. I think in the time frame 5 to 10 years from now, there are going to be a lot of claims about what companies and their boards did or didn't do to prepare the company for climate change. I think things as simple as diversifying supply chain, considering having redundancies in your source supply, relocating facilities, having mechanisms on important factors that can affect your company, like temperatures, rising temperatures in your important locations. For companies that, for example, are very water dependent, agriculture, brewing, things like that, mining, what are they doing to ensure that they have supply? I think those are things boards should be talking about today, because the claims that are going to come aren't going to come tomorrow, but they are going to come from over the horizon. And I think it's going to be a very big deal. And the thing I would want to ensure if I were charged with advising a board is you need to have that in your agenda several times a year to make sure that there are people in management whose jobs it is to be trying to anticipate problems that could affect the company, from rising temperatures, from water supply issues, food supply issues, energy supply issues, so that they're anticipating what future operations the company will need. So that's a little bit longer time frame than what you're talking about, but it's something that I care deeply about and that I worry about a lot, and I hope that boards are worried about too.
And look, there's one thing's for certain: the D&O insurance landscape is very broad, and it'll continually evolve. And we'll be talking about risks in 10 years' time. You'll still be writing the D&O Diary.
I don't know if 10 years now I'll still be doing it. You'll still be, working away, but I'm hoping that I'm sitting on a beach somewhere with a cocktail with a little umbrella in it.
That's fair enough. And look, so thank you. As someone who started their journey in their career in underwriting and reading the D&O Diary and appreciating it from afar, thank you for coming on the show. It's been fantastic to talk to you. And we look forward to having you on again one day in the future.
I look forward to coming back. Thank you for having me. This was actually a very interesting exercise and dialogue. Thank you.
Thanks, Kevin.